Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to be talking about the bearish evening star pattern, which is a powerful reversal formation that signals the potential end of an uptrend. You discover how this trade candle pattern can help you identify prime shorting opportunities in the Forex market. By the end of this video, you understand exactly how to spot this pattern, interpret its significance, and execute profitable trades with proper risk management. This pattern has helped countless traders capture significant downside moves, and today you will learn the exact strategy to implement it in your trading plan. So without wasting any much of your time, let's get started. First, what is the bearish evening star pattern? The bearish evening star pattern emerges at the peak of an uptrend, consisting of three distinct candlesticks that signal a potential reversal. The first candle appears as a strong bullish move, displaying a large green body that continues the existing upward momentum. The second candle creates a gap up, forming a small body that represents market indecision. The final third candle opens with another gap and closes bearish, penetrating deep into the territory of the first candle's body. So now this bearish evening star pattern tells a compelling story of shifting market control. During the first candle, buyers maintain full control, pushing prices higher with confidence. The second candle reveals the first signs of buyer exhaustion. Prices gap up but fail to advance significantly, indicating that buying pressure is waning. Now, by the third candle, sellers have seized control, overwhelming any remaining buyers and forcing prices lower. This dramatic shift in market sentiment often triggers further selling as trapped buyers rush to exit their positions. The effectiveness of this pattern lies in its ability to capture the precise moment when market sentiment shifts from bullish to bearish. When you spot this formation after a strong uptrend, it often indicates that smart money is beginning to take profits while retail traders are still attempting to buy at elevated prices. So let's quickly look at the charts to spot this pattern. Then we'll talk about the trading strategy. So to effectively trade the evening star pattern, you must first confirm its formation in the context of a strong uptrend. So starting with this, you can see we were in an uptrend here. This was an uptrend, and trying to spot the end of this uptrend or the top of this uptrend, we'll be looking for key patterns or candlestick patterns around the top, or also around key levels like your support and resistance levels. In this case, we are looking at the resistance levels. So your entry point should occur when price breaks below the low of the third candle, confirming that sellers have taken control. So let's quickly look at the charts. You can see this is a major key level right here, and this is a major key level. This is a resistance level, and we should be looking for the bearish evening star candlestick pattern. And as you can see, we have one right here at the top of this uptrend. You can see this we have the bullish candle, the first candle, then we have the dodgy star candle, and then we have the third candle closing below the first candle, and this is our bearish evening star candlestick pattern. And looking at this, we can look to place our short trades at the close of the next candle with our stop losses above the high of the pattern, the entire pattern. And you can set our take profits at we could look for the nearest significant support level or previous swing low for our take profits. Also, a conservative approach suggests taking partial profits at 1:1 risk to reward ratio while letting the remainder run to capture extended moves. So this pattern works particularly well when it forms near major resistance levels or psychological price points. So let's look at another example. On the chart. Right, we have this example right here. So we have two examples and I'm going to explain. Remember, the first step is looking at the market context. We were bullish, we had this bullish trend pulling back into this support into this resistance level right here. Trying to spot the key level. Let's just switch the line chart and you can see price reacting off of this level here, and this is a major resistance level. So let's switch back to the candlesticks and you can see this price is reacting off of this major resistance level right here. You can see our bearish evening star candlestick pattern. We have one here, we have the bullish candlestick, we have the doji, the star, indecision, and we have the next candle, which is a bearish candle closing well into the body of the first candle. And consequently we have subsequently we have further candles closing below the low of that candle, and we could look to enter a bearish trade at the close of this candle, which confirms the bearish trend, and our stop losses are above the high of the star. We could set our take profits at major swing lows or support levels like this one. So we have another example. Remember our key level, our resistance zone. You can see price retracing back to touch our major resistance level here, and we started pulling back and started pushing to the downside and looking to enter into this trade based on that market context. You can see this bullish candle, then we have the doji, the indecision, and the next candle, which is the bearish candle, closing below the entire, even gapped the candle even gapped below it, well below it. And you can see you could just take your short trades at the close of the next candle with your stop losses above the star and take profits at major swing lows or a 1:2 risk to reward ratio. So to enhance your success rate, incorporate volume analysis into your decision making process. Higher volume during the bearish third candle adds significant weight to the pattern's reliability. Additionally, consider the overall market structure, just like we've done, and time frame alignment. So patterns forming on higher time frames typically produce more reliable signals. So position sizing remains crucial for long-term success. Never risk more than 1 to 2% of your trading capital on a single bearish evening star setup, regardless of how convincing it appears. Consider scaling into positions if price action confirms your bias rather than entering your full position size at once. You see the confirmation of this trade using volume. You can see increasing bearish volume, selling volume. At the same time, we had this candlestick pattern right here. Let's look for this one. Okay, we had the candlestick pattern right here, and you can see volume analysis didn't exactly give us a confirmation because we had increasing buying volume at the time we had this our candlestick pattern. Then we started having the increasing selling volume right here, where we had this volume. It's increased selling volume here. We have increasing selling volume. So that's when we entered this short trade. That's why I placed my short entry here. So that's it for this video. You've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.